You're a business owner, you have one or several partners with you in the business, you have a shareholder agreement which clearly identifies what is going to happen for you to buy one of the partners out. The question is, where are you going to find the money to buy those shares from the partner? This is what this presentation is going to cover. And the two scenarios that I'm going to be discussing in more details are the trigger that is a death or if one of the partners become disabled. This presentation is a short version of a full presentation that I've done that is about 45 minutes long, but since a lot of business owners are so tight with time, I thought that 20 minutes would be more appropriate. But I encourage you, after you've watched that video, if you enjoyed it, to watch the longest video of 45 minutes because you're going to get more information, more details, and a better understanding at the end. First of all, quick disclaimer, this material is for information purpose only. I am not a lawyer, I am not an accountant. I always encourage you to check with them before you do any changes or process any of the suggestions that I recommend here. Ideally, I would be connecting with the lawyer and the accountant anyway, but if you're dealing with another advisor, this information should be confirmed by your accountant or tax advisor. Quick introduction, my name is Antoine Rempp. I'm a certified executive advisor and an engineer by trade. I've been in the industry since 2010. I work mostly with professionals and business owners. I published a couple books about life insurance, and the second one here is a wealthy physician. I have a great connection with physicians since my dad is a doctor, and I have a couple more doctors in my family, and my mom is a nurse. So I'm quite connected with the medical community, and I have an affinity with working with medical professionals. But I work with business owners in general and medical professionals. And I am bilingual, originally from France, so you can reach out to me in French or in English. What's in the shareholders agreement? Very quickly, the major items are a list of owner or partners. Then you would have the firm or enforceable obligation to buy or sell that would be clearly identified in there. Then you would have a very clear definition of the trigger and the value of the business, or a way to calculate what the business would be worth at the time of the trigger. Where does the buy-sell fit in, the buy-sell insurance? There's three health scenarios that I'm going to talk about today. The first one is when a partner dies. Then we're going to look at what happens if a partner becomes disabled. Then we're going to finally briefly touch on what happens when a partner becomes critically ill. And that third scenario is usually not addressed inside the shareholders agreement because the partner would be coming back to the business hopefully within 12 or 18 months. Otherwise, he quite often would become disabled, and then that would trigger that scenario inside the shareholders agreement. There's a very interesting tax strategies for business owners with the critical illness coverage, and that is what I'm going to be talking about more at the end of that presentation, very briefly. Let's look at the buy-sell life insurance and how it works. Well, it's pretty simple. If you have a partner who dies, the death benefit would be paid to the company or the partner that is left behind. Let's assume here it's a company. The company would buy the shares from the deceased estate. So the family of the partner or the estate would receive money for the work the partner did. And because they bought the shares, the remaining partners keep full control of the company. So again, it's pretty straightforward. You're either dead or you're not. It's compared to disability insurance. Life insurance is quite easy to put in place, and a lot of those agreements are usually well covered by life insurance. Now, disability insurance is a little bit more complex. There's three different types of disability insurance, and I'm going to talk about all three of them, even if the most important one for this purpose is the third one. So first, we're going to look at personal disability insurance. Second, we're going to look at business overhead expense disability insurance. then we're going to look at disability buy-sell insurance. And that third one is the one that would be most interesting in terms of buying the shares back, but the first two for business owners are just as critical. And what I find is that a lot of advisors in the industry don't talk about disability insurance because it's too much work and it's too complicated for the advisor. And I know myself, the first 4 years I worked in the industry, I sold no disability policy because, again, I never really got over the learning curve. But for the last 4 years, I've been very busy talking to business owners and professionals about disability, and I think it's such a valuable coverage, despite the fact that it's confusing for most people, including accountants and lawyers. If it's confusing for insurance brokers, you can just imagine what it is for folks that are outside of the industry. Now, let's see where those three types of disability insurance would fit. If we have three partners here, we have a business and a shareholders agreement. So the personal disability insurance would be held by each one of the partners personally. So each partner would have their own policies that they would pay for personally, and they would be the beneficiary of that policy. Then the business would purchase a business overhead expense on each one of the partners, and the business would own the policies, pay the premiums, and be the beneficiary whenever the time comes. And for the shareholders agreement, same thing here. There would be a policy on each one of the partners, and depending on how the situation is structured, either the partners would be owning the policies or the business. And I'm going to show you both situations in the next slide. So let's look at one scenario with three business owners again who share the overhead expenses, which is admin, staff, utilities, loan payments, and probably a whole list of other expenses. And usually when you have three business owners, if they each contribute the same, they would cut those expenses 3 ways, and they each take care of their share. Now, Mr. Green works and gets paid 200 grand, and let's assume that all three of them would have the same treatment. But for the sake of simplicity here, we're going to just look at Mr. Green. He's working, he's making that money, but now he becomes disabled, either because of an accident or because of a disease. Can't work anymore. What happens to that income that the business was paying him? Now, if you're Mr. Green and you've put a lot of effort, time, and energy in building the business, you sure hope that the income is not just going to dry out because you can't work. But if you're Miss Blue or Mr. Gray, same thing, you've put a lot of time, effort, and energy in building the business. Now you've just lost one of your key partners. He's not contributing to the business anymore, and now you're sure hoping that you're not going to have to draw the same income out of the company to pay him despite his ability to contribute to the business. That's where the personal disability insurance would kick in. Again, that policy would be owned by Mr. Green on himself, and the insurance company is going to take care of looking after Mr. Green's income by providing him a monthly benefit that is tax-free. So we looked here at 120,000, so that's 10,000 a month. That would come to Mr. Green on a tax-free basis, which is pretty much the equivalent of what the business was paying Mr. Green. What this means is that the income that the business was paying Mr. Green can stay into the business. And the other interesting thing about having a personal disability that kicks in is that it starts the clock for the disability buy-sell insurance. I'm going to talk a little bit more about that in a later slide. Now, Mr. Green is not able to work anymore, so he's kind of moving away from the business. He's receiving his income from the personal disability insurance, which is good, but what happens to his share of the expenses? Again, if he's not working, it's probably a hard request to want him to pay for this, and that's where the business overhead expense insurance policies that the business took on Mr. Green is going to take over for those expenses. That allows Miss Blue and Mr. Gray to continue their efforts to find someone to replace him or to hold on the fort without having to take care of that share of these expenses. The other interesting thing about the business overhead expense insurance is that the premiums are a taxable write-off. They're considered expenses to the company. So as long as the company pays for the premiums, they can write them off at the end of the year. Always very interesting for business owners. Now again, Mr. Green is not coming back anytime soon. So the partners are going to look for replacement, either temporary or more long-term. So Mr. Yellow comes into the picture and he's going to start working. Might not be as efficient as Mr. Green up front, but still is going to contribute to the business. And the good thing is that the income that was destined to Mr. Green is going to be available for Mr. Yellow. Now, over time, let's say it's been 2 years and Mr. Green is not gonna come back to the business. What happens after 2 years? First of all, the business overhead expense usually only lasts 12 or 24 months. In this case, we're gonna assume that it was available for 24 months. So that insurance is not gonna cover the expenses. The good thing is that Mr. Yellow is now looking after those expenses, so it's not affecting the partners or the business as much. But Mr. Green being disabled for 2 years, the shareholders agreement says that after 2 years, we're going to be able to buy the shares back, so we don't have to keep carrying you. That's what the buy-sell disability insurance is going to do. So quite often there could be some litigation between Mr. Green and the remaining partners about when the disability really started. And while the remaining partners might consider the date to be earlier than Mr. Green, that could be sources of conflict. That's why the moment Mr. Green starts receiving an income from his personal disability insurance, that would start the clock for the shareholder agreement, 24 months, for example. Now, the whole point of the buy-sell disability insurance is to be able to buy the shares from Mr. Green. So the moment that Mr. Green is being disabled for 2 years, the buy-sell disability insurance would pay the business a certain amount of money that was decided up front. The business is going to use that money to buy the shares from Mr. Green, and the remaining partners have 100% control of their company again. Some questions to ask. It's quite important to structure the shareholders agreement properly or these insurance policies. Question would be, who owns the policies? Who pays for the premium? Who is the beneficiary? And I'm going to touch on these aspects in the next slides. Then how will the benefit be paid? Is it going to be a lump sum? Is it going to be monthly payments? When does the clock start? I already touched on that. What is the definition between legal and insurance for totally disabled? That's one that is quite often not necessarily addressed properly because lawyers don't necessarily know what the insurance definition is. Now let's look at this scenario again with only 2 partners. So we have Miss Blue and Mr. Green. They both have drafted a shareholders agreement together to protect each other's, and Miss Blue would buy policies on Mr. Green, so a life insurance policy and a disability buy-sell insurance policy. So Miss Blue would pay the premiums and she would be the beneficiary on the policies for Mr. Green. Same for Mr. Green, he's going to buy policies on Miss Blue, he's going to pay the premiums personally, and he's going to be the beneficiary. So let's assume that Mr. Green becomes disabled, he has an accident, a disease, nervous breakdown, and 2 years, 24 months later, he's not coming back. So again, the disability buy-sell would be triggered, and what this would do is that Miss Blue would receive a pile of money that she would be able to give Mr. Green in exchange of the company shares, and now she has full control of the company again. So that's the way for you to make sure that you protect everything you've built, and it's also peace of mind for Mr. Green that the money is going to be there for him to be bought out and to keep on fighting his disability. Now, if we look at the personally owned buy-sell disability insurance, as benefits and inconvenience in having a policy owned personally. So the benefits would be a tax-free benefit. When you pay for the policy personally, there's no tax on the benefit, which means that you can usually get an amount that is closer to what the shares would be worth. The negative side of it is that the premiums would have to pay with personal dollars, and depending on what your income is or how expensive that coverage is, that could push you in a higher tax bracket. The risk of a partner not paying the premiums because they forget or because they don't want to, and it is not suited when you have more than 2 partners in the company. Let's look why it is not very efficient to have personally owned policies when you have more than 2 partners. Again, as we showed before, if you have 2 partners, there would be 4 policies. Now, if we had a third partner, Miss Blue would have to get 2 policies on Mr. Yellow, and Mr. Green would have to get 2 policies on Mr. Yellow, but Mr. Yellow would have to get 2 policies on each of his other partners, and now we just went from 4 policies to 12 policies. You can see how quickly this gets out of hand, and if you added a 4th partner, then you would need 24 policies. That is why usually when you have 3 or more partners, the company would be the one who purchases, pays for the premiums, owns the policies, and is a beneficiary for all those policies on the different partners. So the corporation owns the policy, pays for the premium, and is a beneficiary. Benefits and inconvenience of having the company pay and own the policies. Benefits is that there's less risk of policies lapsing because the company would be the one making the premiums, paying all the premiums. There's no need to increase the personal tax rate since the company would pay for those policies. It's a more efficient way to pay for these policies since you're going to use corporate after-tax dollars instead of personal after-tax dollars. Negative is that usually the benefit is going to get paid tax-free into the company, but then you have to get the money out of the company to buy the shares. So there's going to be a taxation there, which means that you're probably going to be short a little bit on the amount you need to buy those shares, which means you have to come up with some additional cash to be able to get those shares from the disabled partner. If you look at the taxation, first of all, premiums are never deductible for those buy-sell disability insurance. Doesn't matter who owns the policy, who pays for them, it's not deductible. And the benefit, again, depending on who owns the policy, if the company owns the policy, the benefit would be paid to the company tax-free, but then you have to get the money out of the company to buy the shares, which means you're going to lose some because of the taxes. If you own them personally, you receive the money tax-free, which should be the amount that was required to buy the shares. Now, why would someone look at personal or corporate? Let's say you have 2 partners, and then you can ask yourself if you should have the policies owned personally or corporately. If your goal is to have maximum funding through insurance, then you would look at a personal coverage. That's the cleanest and best way to get the most amount of money because there wouldn't be any taxes on the benefit. That's usually applicable for companies who don't have as much liquid cash, who have a lot of hard assets and, for example, recently acquired a building and had locked a lot of their cash into the building and would be really affected by one of the partners becoming disabled because they wouldn't be able to come up with the money. So that's where personally owned policies would be more efficient. If you want to look at the most cost-effective way, the corporate ownership is usually better since you're going to use after-tax corporate dollars instead of personal dollars to buy the policies. The challenges though is that you're not going to get the full amount that you need to buy the shares since you have to pay tax to get the money out of the company, and that's for owners who don't think they're going to get sick or who have liquid fairly easily available to top up the amount needed to buy the shares. Again, I touched on the definitions a little bit. You want to make sure that the definition in the document match the definition with the life insurance company, because if you have a definition in the document and the insurance company doesn't agree that the partner is disabled because their definition doesn't match the legal definition, this means that they might not decide to pay out or not at the right time, which is going to happen in a situation where someone is disabled. There's a lot of stress, there's a lot of headaches already that just means higher risk of lawsuits, which is what we're trying to avoid by putting in place those shareholders agreement. What is a definition of disability, totally disabled? Well, the insurance definition is such as someone who is totally disabled due to an injury or a sickness, is unable to perform his or her regular occupation and is not engaged in any other occupation and is under the care of a physician. So it's a pretty simple definition, but still you want to make sure that the legal definition is as close as possible as this definition. So let's look at an example with some costs. That's the only slide that I have added some costs because every situation is different depending on the age or the amount of coverage needed or the gender or if they're smokers. As I said, there's a lot of different variables, but just so you have an idea of what this could look like in terms of cost, because I find a lot of people always assume that those insurances are going to cost way too much. So here we have Miss Blue is 35, Mr. Green is 55, Mr. Gray is 40. Their personal disability insurance would give them a benefit of $6,000 a month. That would be tax-free again, that they will receive. They're all considered non-smoker and they have a 90-day elimination period. This means it would kick in after 90 days. It would go all the way to the age of 65. And I'm not going too deep into those definitions, but the full version of that presentation would. So I encourage you again to watch the full version. In this case here, the policy would cost $332 a month for Miss Blue, would cost $422 for Mr. Green, and $219 for Mr. Gray. And again, those costs have to be paid up by the partners at a personal level. It's just one of those necessary evil. It's a cost of being in business. It's you that you're protecting. Now, if we look at the expenses, we look at a BOE, business overhead expense for $5,000 a month. So that would be $5,000 per partner. So we're considering that the entire expenses for the business would be $15,000. Now the policy would kick in after 30 days and last for 24 months. And again, those premiums would be tax write-offs. So if we look at the cost for Miss Blue would be $104, for Mr. Green $200, and for Mr. Gray $93. So those costs would be corporate dollars and would be expensed at the end of the year. Now, if we look at the shareholders agreement, again, you would buy the buy-sell life insurance and the buy-sell disability insurance. We're assuming that the shares would be worth $150 for each one of the partners. The disability would pay out after 24 months, and the life insurance would pay out on death. And the policy we have illustrated here would be a term 10 for $250,000, since the cost difference between 150 and 250 is very negligible. So it's actually sometimes cheaper to buy 250s than 150 because of the cheaper cost per volume. Now, if we look at the DI, the cost would be $43 a month for that coverage, $112 a month, and $46 a month. So you can see those costs are much lower than for the personal DI, and the reason being is that you have to wait 24 months before it gets triggered. And also that cost would be corporate. So the corporation, the business would pay for those policies. On the life side, it's even cheaper, $12 a month for Miss Blue, $47 and $19. One important fact to know is that for you to buy disability buy-sell insurance, you need to have some personal disability insurance. Either personal through a personal policy or group disability insurance as part of the company plan. But you cannot buy buy-sell if you don't have first a personal policy yourself, which makes sense anyway since they both address different needs. Now let's talk a little bit about the impact of a critical illness on a partner. Those major illnesses that are looked at would be cancer, heart attack, and stroke. Those are the top three. Usually the partner tends to come back to the business within 6 or 18 months, or we hope. And that's why those scenarios are not necessarily addressed in the shareholders agreement. The best way to do it is to purchase a keyman insurance in addition to a buy-sell disability insurance. And there's a very tax-efficient strategy for business owners to allow you to get the coverage and get some tax efficiency at the same time. Now, some people ask me why you would need both the DI, the disability, and the critical illness insurance, because quite a lot of people think they do the same thing. Not necessarily. So the disability insurance covers your inability to work because of an accident or sickness. So first of all, the critical illness doesn't cover for accident, only for illnesses. And the inability to work, it would usually kick in after 90 days or 60 days, depending on the definitions. And what the disability insurance offers is a monthly indemnity, as opposed to the critical illness. Some examples of causes for disability would be stress, anxiety, depression, or some accidents like fracture, soft tissue, or back pain. Now, if we look at the critical illness insurance, that's usually one of those cancer, heart attack, stroke, and if you survive 30 days, then you're going to get a lump sum. That lump sum could go from 10,000 to 2.5 mil, and that one is more to find a replacement or to help with medical bills or just to go and have fun before the time comes. Some examples would be cancer, including breast cancer, heart attack, stroke. Now, some examples would have both the DI and the CI kick in. Some cancers or neurological disorders would trigger both the disability and the critical illness. So that's just to answer the questions that a lot of people have regarding the difference between DI and CI. Now, I encourage you to make sure you work with an expert who deals with disability insurance every day, because as I said, not every advisor out there understands DI properly. There's very few of them actually who really have a good grasp of how it works. And I am aware that money doesn't grow on trees. I'm a business owner myself, and I also know that you don't have enough hours in the day, but it is important because you're protecting yourself, you're protecting your business. And as a broker, I get paid by the insurance company, so I can offer you a free review of your shareholders agreement, and I can offer you some free quotes for those different types of coverage. No obligations. It's really just going to help you identify what the risks are and what the cost would be to cover those risks. Again, my name is Antoine Rempp. My cell phone is in Ontario here. I also have a landline in Alberta. You can't text me on that landline, but don't hesitate to email me, and I would be happy to hear from you about things that can be improved in the presentation or about questions you have for your business or your shareholders agreement. Thank you for listening, and again, I encourage you to watch the longer version since it has more information and more details about the different types of coverage, and there's a few more slides in it. Thank you and have a good day.